Hello and welcome to Fed Tax 101. Today we're going to discuss one of the cornerstones of federal tax law, the clear reflection of income doctrine. If you boil down the thousands of pages of federal tax law to its core, the entire thing really has only one purpose: computing how much federal income tax you owe the government this year. That's it. It's that simple. What number do you put at the bottom of this year's tax return? The clear reflection of income doctrine is one of the most important tools that the tax system uses to reach that simple objective, making it one of the most important concepts in all of federal tax law. And yet, it's also one of the least understood. The clear reflection of income doctrine is found in Section 446 of the Tax Code and Regulations. It's important to understand Section 446, not only because it's one of the basic building blocks of federal tax law, but also because it's one of the most powerful tools that the IRS can use to enforce those laws. Section 446 has two elements: a substantive component and a procedural component, and both are equally important. Substantively, Section 446 tells you that in computing your tax liability, you have to use a methodology, an accounting method, that clearly reflects your income. If you don't, the IRS can step in and make you compute things their way. If you scan through the Section 446 regulations, you'll see this concept, the clear reflection of income, referenced over and over and over. But what does it mean? Well, there really isn't a hard and fast definition of clear reflection, but the best way to think of it is in terms of matching. Constitutionally, the tax system can only tax you on additions to your wealth, not on money that you already own and have already paid tax on. So, if you receive $1, say from a customer, we have to know exactly how much of that dollar is the return of your own money that you've already paid tax on, your capital, and how much of it was earned by the way you spent that previously taxed money. And that's where matching comes in. We can get the clearest picture of how much of that dollar was previously taxed by matching the gross receipts, in this case the dollar, with the costs that you spent to earn the dollar. Because you only have to pay tax on the difference, the addition to your wealth, we need to match up those two items as closely as possible so you don't pay too much or too little tax on that particular dollar. Reaching that goal requires applying two separate concepts. First, what are the buckets into which I'm trying to drop items of income and expense, my tax year? And second, how do I try to get the related items of income and expense to both drop into the same bucket, my accounting method? Let's start with the taxable year notion. Back in 1931, everyone was still trying to figure out some pretty basic questions regarding the new tax system. One of those questions was, when do we measure your business's gains and losses to decide how much tax you owe? This question was presented to the Supreme Court in the case of Burnett versus Sanford and Brooks. It's what's called a vocabulary case, a case whose name and facts you should become familiar with if you aren't already. Let me simplify the basic facts to this. The taxpayer had a multi-year contract with the government. For various reasons, it turned out this contract was going to be an overall loser, and over the course of the several years, it would require the company to spend more than it would get paid, so no profit. As it turned out, though, during one of those years, the company did get paid more than it spent during that particular year. The taxpayer argued that because it lost money overall on the contract, it should not have to pay tax on anything it received at any point under that contract. In other words, you should use a transactional approach to computing your taxes. The IRS disagreed. It said you can't wait to see if a given transaction is a winner or a loser. Instead, you have to take the facts of each tax year and determine your tax liability looking only at what happened during that year. In other words, an annual approach to taxes. The Supreme Court agreed with the government. It held that on the last day of your tax year, you have to take a snapshot of any facts that are either known or knowable to you. You can't even wait until the first day of the next year to see if anything changes. You do this every year, with each tax year standing on its own. So that creates the buckets, the annual tax years, into which we're trying to match related items of income and expense. But how? Well, that's where the other part of the clear reflection doctrine comes in. Take this year's set of facts and apply your accounting method separately to this year's earnings and to this year's expenses. You put on this year's return however much of those two separate numbers your accounting method tells you to. Sometimes the entire amount of one or both numbers goes on this year's return. Sometimes your accounting method makes you wait until a later year. Ideally, your accounting method is going to result in putting on this year's return the exact expenses that you spent to earn the income that your accounting method also tells you to put on this year's return. That would create a perfect match and would give you the clearest picture, would clearly reflect how much of that dollar that we've been discussing was already yours and how much is new wealth that you have to pay tax on. That's the ideal, but it doesn't always happen that way for a lot of different reasons. So, what Section 446 says is you have to use an accounting method that matches income with related expenses as closely as you reasonably can, meaning you should not have very many tax years, if any, between the tax years in which you separately recognize income and related expenses. If your accounting method does not match receipts with related costs closely enough, it won't clearly reflect your income, and the IRS can step in and make you do things differently. Remember, I said Section 446 has both a substantive and a procedural component? Well, the procedural component basically boils down to this. Once you select an accounting method, you have to keep using that same accounting method every year in determining what receipts and what expenses you have to put on this year's return. Consistent use of the same method year to year is an important way of making sure you clearly reflect how much of that dollar has to be paid to the government. But obviously, sometimes things change. You may realize that there's a different accounting method that would work better for you. It may be simpler to use, or it may result in lower taxes this year. You also might realize you've been doing things completely wrong, and you need to adjust your method in order to correctly compute your taxes. Sometimes the tax law itself changes, and you have to change to a different accounting method to comply with the new tax law, whether you want to or not. Because consistency is so important, Section 446 requires you to get the IRS's permission to change your methodology in any way. The reason doesn't matter. You have to get the IRS's consent to change your accounting method. There are specific and very technical ways to do that, which we won't get into right now. And here's the rub. If you don't get the IRS's permission, you're automatically using an unauthorized accounting method, and Section 446 allows the IRS to make you start using any accounting method that the IRS wants you to, within certain limits. That's the case even if you've changed from the world's worst accounting method to the world's greatest. If you made that change without the IRS's permission, you have automatically violated Section 446, and you've given all the cards to the IRS if they audit your return. So to wrap up our discussion of the clear reflection of income requirement, compute your taxes using whatever facts are known or knowable at the end of the year. Apply the same methodology to those facts that you used last year unless the IRS says otherwise. Whatever accounting method you use must clearly reflect your income. Your income is clearly reflected if you get a reasonable match between this year's gross receipts and what you spent in earning those receipts. If your accounting method does not clearly reflect income, or if you changed to your current method without IRS permission, the IRS can change your accounting method to one they like better, within certain limits. That's the basic framework, which is essential in correctly computing your taxes, which, at the end of the day, is all that thousands and thousands of pages of tax law really care about. If you want to read more about the clear reflection of income doctrine and get a head start on your own research, here's a list of prominent cases to get you started. Well, that's it for this episode of Fed Tax 101. Keep checking back for more. So long, everyone.